as we look at the business environment, the corporate environment, earnings, the economic kind of framework in terms of overall macroeconomic condition, as well as the Fed, I do think we're on firm footing. And we wrote this presentation about 3 days ago. I also note that over the last 3 days, we've seen a fairly significant correction in the market, and now the market is negative. The S&P 500 for the year, cryptocurrencies are down 50%. Silver has crashed, so who knows? But when you look at the underlying economic environment, I do feel like we're on firm footing and a foundation that we can build on and have another positive year. So tonight I thought I would just go through a recap of 2025 and to just examine this idea of being on firm footing. In terms of financial markets, if we look back, it was another good year. It was the third double-digit S&P return, positive return. You can see the S&P came in at just over 16%, the Dow at 13%. The NASDAQ was the leading of the broad domestic indexes, up 20%. Large cap outperformed small cap, as we can see in the Russell. European developed markets continue to be strong, and that's one of the things that we'll look at is the kind of relative value and differential of European and international stocks to domestic. China came back, roaring back after a really difficult start to the year with their real estate problems. And across the entire global economy, markets returned about 20%. It was a very good year. If we look back just on the S&P 500, it was a year that was marked early with volatility, particularly the catalyst was the rollout of really very aggressive tariffs. Those normalized and became more predictable, and the market just traded through a lot of unknowns in a very consistent upward trending way. And you can see that in kind of where we were in 2025 in terms of the S&P 500. If you look at sectors, no big surprise that communication services, that's a sector that includes companies like Google and Meta and others, and information technology driven by AI really were the leading sectors in the S&P 500. We saw that through the Magnificent Seven, which we'll talk about in a moment. But by and large, it's been just a really very positive market since the lows in October 12th of 2022. You can see the cumulative returns across each of these sectors. It's really been a very good market for us over the last few years. PE ratios can continue to be above their national historical average. Domestic equity is trading today, this is a little bit outdated, trading today at about 28 or 29 times. International stocks at about 19 times earnings. Large cap, particularly technology and mega large cap, is trading at higher multiples than small cap, but it does give you a sense of relative value here. The S&P 500 above historical averages, and the small cap below. So that's just where we are and have been over the last 15 years. All of this, the PE ratios, there's talk about, is there a new norm? I don't know that there's a new norm for a 30 PE ratio, but something, mid-20s that are off the historical averages. I think there could be an argument made, and largely it's due to supportive fundamentals, corporate earnings. And if you just look here by sector, in third quarter, year over year, the rate of growth in earnings is pretty significant across a number of these large sectors in terms of technology, utilities, surprisingly driven by AI, industrials, financials, materials. there's a lot of positive earnings growth in the market, and I think it will be supportive of equity values going forward. The Magnificent Seven, those seven stocks that we've talked about a lot over the last couple of years, continue to outperform. The Magnificent Seven had a 23% return in last year. The S&P 500 overall, a 16% return, as we saw. So the Magnificent Seven continues to outperform, not to the same degree, but there continues to be a premium there. We're seeing that trade down, of course, over the last few days, but the overall trend has been for a concentration of returns in these seven large S&P tech-oriented stocks. And I think that that's something that will likely continue in 26. Overall, we saw, very little volatility, at least on a historical basis, back in April, of course, with tariffs. But the rest of the year, there wasn't a lot of volatility given a very volatile world of all that was happening. The markets kind of just traded through a lot of news in 2025. Um, Surprisingly so, but the volatility was just absent last year. In terms of international equities, they represent, at least on a price to earnings ratio, better value for sure than domestic equities. We talked about domestic equities being trading at something around 30 for large cap domestic, and you can buy large cap developed market international stocks for something closer to 14 times. So there's a differential there. There's a value there. We've seen that gap close over the last few years, and it's a gap that I think will continue to see close. If you just look at recent performance, Europe and Japan has really done quite well relative to the S&P 500. If you kind of strip out some of that outlying the NVIDIA Mag 7 effect in the marketplace. Fixed income continues to trade in a range, which is good. Corporations can plan and to think about capital structure in a more predictable way. The 10-year Treasury continues to trade at about 4.25, 4.20 right now. It's been range bound for the last year. And we've seen just a healthier dynamic in the yield curve. It's increased in terms of its of its slope. A few years ago we were talking about negative yield curves and what that would mean for the economy, and we've seen that reverse and revert to a much more healthy, again, supportive yield structure in the fixed income market. Again, in this theme of being on firm footing. Corporates continue to show signals of or signs of investor confidence, just in terms of fixed income and yields. On a historical basis, certainly being attractive, and corporations right now are able to access capital at very favorable rates, which is supportive again to earnings and long-term performance. Again, like stocks, we just didn't see a lot of volatility in 2025. Unusual, but nothing to complain about for sure. So as we just think about and look at the overall market in 25, and even longer than that, it's just been a very positive story. In terms of the economy, lots to feel good about here. Again, this idea of being on firm footing. We're seeing inflation come back into a tolerant range. The Fed is targeting something around 2% in terms of inflation. It's hovering right here, range bound, right in the upper 2%. The Fed would like to see it come lower, but it's not the red lights and alarms that it were, even just 2 or 3 years ago. It wasn't long ago that we were talking about a 9% inflation rate. So inflation's come down, and the Fed, even in their last conversation, had talked about, and they used the words a potential soft landing. So a soft landing is still very much in the cards. What the fly in the ointment is really is the job market. 2025 was the worst year for hiring since 2020. I think we're starting to see the effects of AI, and um, it's been a difficult market for particularly for for college graduates and those entering the workforce and trying to find that first job. Those entry level jobs have become quite um, quite precious in terms of, but it was a difficult year. However, we saw unemployment come down. This may be seasonally adjusted in terms of holiday employment. But going forward, there's a sense that the corporate environment will support more upbeat employment prospects. And as we look at revenue growth expectations and what's being reported from employers is that they expect to add more jobs to the to payrolls, and that would be supportive. And it reminds me that a lot of, not a lot, but much of the employment data right now we're getting from private sources. As you can remember, there was a break in the data this year, and increasingly private sources have become such an important source of data, and this is an example of that. Consumer confidence is the still weak, and it's so important because about 2/3 of the domestic GDP is around domestic spending. But what we're seeing is even though the consumer doesn't have a rigorous confidence in the market across any number of these dimensions, they are still spending. And corporations are able to pass through higher earnings, and there's a resilience there, again, of firm footing. Overall, the GDP showed growth in the third quarter of 2025 after a strong second quarter. Every expectation is that the fourth quarter will come in positive as well. So again, firm footing. The Fed, uh, after a series of tightenings at their last uh, open market committee meeting, they held rates steady. They're in between this inflation being a little bit higher than what they would like, plus a sense of vulnerability yet to see what tariffs and other trade policies and other inputs will have on inflation, trying to protect inflation and kind of the way that it's been reduced over the last few years, but also having an eye on employment, wanting to be stimulative to support the job market. So they're really kind of in between these two forces right now. Um, the sense is that if you ask the Fed, they're signaling one cut in 2026 from 3 3/4 to 3.5. If you ask the market's a bit more bullish than that, and they'll say, no, there's probably going to be two cuts that get us down to 3 1/4. Of course, that would be a stimulus for the economy, a stimulus for corporations and households as well. So the expectation is that rates will continue to come down modestly, good for fixed income, good for risk assets overall.